A very good morning and welcome to this video. In this video, we will be trying to understand the different types of financial assets. Before we could understand the types of financial assets, let us understand the meaning of financial assets. An asset to qualify as a financial asset needs to fulfill three important conditions. The asset must be owned by an individual. It must be something that has monetary value, and this monetary value need to be derived from a contractual claim. So with this, we can understand the definition of financial asset. Financial asset is an intangible asset. We understand that intangible means that cannot be touched, but they are liquid in nature, and they derive the value from the contractual claims or from owning an equity instrument of another entity. Examples of financial assets are cash and cash equivalents, bonds, marketable securities, mutual funds, derivatives, fixed deposits, equity shares, insurance contracts, and many more. Today, let us understand these types of financial assets one by one. The first is cash and cash equivalents. Cash and cash equivalents are a type of financial assets that includes cash money, checks, and money available in bank accounts and while generating income during the short term. These investment securities are short term and easily convertible into cash with higher credit quality. They are usually and highly liquid in nature. Coming to the second type of financial asset, the fixed deposit. A fixed deposit is a facility that facilitates a depositor to get interested along with the principal amount on the maturity date. Fixed deposits refer to the amount that the business or an individual deposit with some other entity in the expectation of earning returns on such money deposited in the form of interest. Example, depositor makes an FD of rupees 1 lakh with the bank at 8% simple interest for 1 year. On maturity date, that is after 1 year, the depositor will receive rupees 1 lakh and rupees 8,000 interest. Fixed deposit facilitates this kind of service for a depositor, where he would be earning interest along with the principal amount on a maturity date. Next, coming to equity shares. Equity shares are financial assets that are purchased from the issuing company. This will be the financial asset to the purchaser and owner's equity for the company that issued such equity share. This financial asset establishes the right to receive dividend to the investor, which is paid by the issuing company. For example, if Mr. X purchases equity shares of PQR Incorporation worth rupees 500, this investment has given the right to Mr. X to receive the dividend from PQR Incorporation and the right to vote on matters of PQR Incorporation. The next type of financial asset is preference shares. Preference shareholders are the holders of preference shares, which give the holder the right to receive dividends. However, they do not carry any voting rights. So like debentures, these holders receive a fixed rate of dividend, whether the organization earns a profit or incurs a loss. In the event of liquidation, preference shareholders have their claim on assets earlier than equity shareholders, but later the debentures and the bondholders. Coming to the debentures or bonds, these are a type of financial assets that are issued by the company, giving the holder the right to receive regular interest payments on a fixed date along with the principal repayment on maturity. Unlike dividend on equity shares, interest payments on debenture is compulsory even if the company makes a loss. And during liquidation, these instrument holders get preference over equity as well as preference shareholders. Coming to the next type of financial asset, accounts receivable. Accounts receivable are a kind of asset, financial asset that is available in the companies. The companies follow the accrual concept and often sell their customers goods or services on credit. The amount that is to be received from customers is called as accounts receivable, net of an adjustment for bad debts. It also generates interest if the payment is not made within the credit dates. Next is mutual funds. Mutual funds collect money from small investors and invest such collected money in financial markets, including equity market, commodity, and debt market. The mutual fund holder receives units in exchange for their investment, which is bought and sold in the market based on the market price. The return on investment is simply the sum of its capital appreciation and any income generated on the original amount of the investment. At the same time, the fair value of the units may diminish, which is a loss to the unit holder. Next, derivatives. Derivatives are financial assets. Basically, derivatives are contracts whose value is derived from the underlying asset used for hedging, speculation, and gaining an arbitrage opportunity. However, unlike debt instruments, no principal amount of investment income accrues from such a contract. Common derivatives include future contracts, options, and swaps. The last one is the insurance contracts. Insurance contracts are another type of financial assets where one party, known as the policyholder, pays a premium to the insurance companies to get the right of getting compensation at the time of occurrence of an uncertain future event in the business that results in the loss of the business. For example, in case of a policyholder has taken a policy which gives the right to the policyholder to get compensation in case of fire, then if the fire occurs in the business, then the insurance company will compensate the business for the loss occurred due to such fire. So with this, we come to the end of this video. Wait soon for the next video. Thank you.